You're in the Business Insurance Zone with me, Steve Savant, national financial columnist and money color commentator. This week on The Biz, the monthly update series for March 2013. And on today's show, the insurance industry update with our special guest, Eric Palmer, nationally recognized insurance expert, all here on the Business Insurance
When it comes
Zone.
to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm your host, Steve Savant, and we're broadcasting to a nationwide audience of financial planners and advisors from Fountain Hills, Arizona, home of America's largest fountain. And with me today, insurance guru of all the industry for the millennial and Gen X set, Eric Palmer. Hey, Eric.
Glad to be here.
Well, why do we have Eric on all the time? Because, you know, I have my boomer view of the world,
Right.
30-year vet. Eric's been in 10 years. He's the new voice of what's coming. These are the people. By the way, you know, everybody's crying for young people to be in our business. And I have to tell you, we're not really recruiting very well.
Right.
I mean, really, we're not doing a really good job.
Well, I think there's an obvious lack of training and recruitment and education available. It's no longer like it was, say, 50 years ago. You went and worked for MetLife, you got an education, they took care of you, they brought you through the industry, and maybe you went out on your own. That really doesn't exist anymore. So we're always open to finding new ways to get people back into the industry and start help this industry thrive, because our population is aging.
It really is. And so when we see young minds like Eric coming online and having the grasp of the industry like he has already, I mean, it's just phenomenal. All right, enough of the kudos. Let's get into it. Listen, I've been reading articles all month, and what I try to do is I try to cherry pick the ones that relate to us. But I have to tell you, one of the Billboard articles that I saw was we just crossed over 15 trillion in mutual funds. Now, my only response to that is, Eric, did we forget what happened in 2008? Have we just blown this off, or what?
Well, has the marketing gotten better, I guess, would also be the other question. If you notice today, there's a heavy aggression in media campaigns from mutual fund providers. And I think a lot of that is because they saw a decrease in sales, or at least a decrease in a point of view of most Americans towards mutual funds after what happened in 2008. So there's been a lot of aggressive marketing, and I imagine that these fund managers or wirehouses or individuals that are selling these products have been very aggressive in doing that. So, yes, that's increasing, but also keep in mind there's been a somewhat recovery in unemployment, which means there are more participants going into these companies that are having mutual funds available through 401k plans. So I'm sure there's some degree of that going on as well. But it's kind of a scary thought because both you and I, as individuals that look at things from a mathematical and a logical point of view, when we're evaluating retirement, mutual funds are a scary device. If you can take the loss like you can take from a mutual fund, or as John Vogel, with a former CEO of Vanguard, would tell you, you're always in the wrong fund at the wrong time. To be increasing that or doubling down on that would be
that's part of it.
problem.
I've seen a lot of boomers doing exactly what you just said. I don't have the time anymore. I got to double down on the market. And keep in mind, and remember, I mean, we're talking 15 trillion. I mean, if the government nationalized savings accounts, we'd be out of debt.
Right.
Hey, listen to this, because they made this article was almost like Canada has its own problem.
Right.
And this article basically says they're not going to work to just age 66 any longer. They're going to have to work longer. As if that was a revelation just to the Canadian market.
Right.
I mean, talk a little about that. I'm just so surprised that they even went out of their way to make this a big article.
Well, I guess it's kind of the old joke where Canada is just now catching up to the music of the 90s. So they're always maybe it's just a slight step behind. But I think what we've discovered 2007, 2008, 2009, they're discovering now, and it really does boil down to the fact that because we live longer, it's a math equation. We have to save more, which means you have to work a little bit longer to be able to save more.
Well, when you think about it, right now, boomers in America, a lot of them are saying, why should I stop at, say, 66? I only have 4 more years to go to age 70. I can max out my Social Security. I can let my 401k stay in the market. I'm going to be forced to take RMDs at 70 and a half anyways.
Right.
I might as well delay it.
Right.
So there's no new news here except for the fact that they're carving it out and making it a demographic issue out of Canada. Now, let's talk about this next one, because we just did a show on premium financing a whole week. And I have to tell you, I've been in this thing 30 years, and this was the most unique approach to premium financing. If you did not see that show, go out to our archives at thebiz.tv, because I'm telling you, that was probably the most profound show, including, by the way, living benefits. But the article, and remember, this isn't us writing this, it says the marketplace for premium financing. They have a whole new idea of what's going on here. And if you didn't catch that show, you need to catch it, because the top affluent always understand margin, leverage, and there's nothing like premium financing with this leverage and the economy of scale.
Right.
To really bring a wealthy person into the most efficient and lowest cost to him. And think about this. Their plan, and I don't want to get too much into this, their plan actually is paid off and down almost always by age 70.
Well, it definitely depends on what age
Wow.
you get in and the structure of the deal. Premium financing is a means to purchase life insurance. So as long as you're establishing that need for the life insurance, you should be aware that premium finance exists and how to get connected with it, because in a lot of cases it could increase your internal rate of return for your client, which is speaking the CPA and the attorney's language. So if you're able to go in there and say, look, we know you need insurance, here's what it's going to cost you, but I've got an opportunity here to make it cost you much less in terms of your out-of-pocket or the liquidation of your assets. You know, the wealthy Americans understand that leverage means a lot, and that increased internal rate of return is significant, and we're thousands of percents higher.
And when you think about recourse notes, I mean, the collateralization, because the cash values on some of these contracts are so liquid, and you're talking about 90+%, you're not talking about a lot of collateral for recourse loans anymore.
Oh, absolutely. The policies are really carrying the weight there.
It is. Think about this. This line bothers me. 14% of elderly overspend in retirement. I mean, I don't have geriatric discipline by now. I mean, I just think about that. I go, oh my goodness. And when I read this article, I was so surprised, because nobody's telling these people I might have to change my lifestyle.
Right. Well, the budgeting is so important. That's why you got to integrate it in your practice.
We do that here, and we look at all the aspects of inflation on certain assets, as well as activity when you head out. When we come back from the break, we're going to continue our monthly insurance industry update for March 2013 with Eric Palmer. And don't forget to enroll in IULUniversity.com for the best training, education, and sales support when it comes to life insurance for retirement income.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Did you know the average 401k runs out of money just 7 to 8 years into retirement? Time Magazine, the Wall Street Journal, and many other publications have warned of the difficulty of saving with a 401k. But what if there was a way to create tax-free lifetime retirement income with no stock market risk? Good news, there is.
You know, living in fear of the next market dive is not the way I want to live my life.
Why would I go out there and take on a risk when I don't need to?
I have a lot less stress knowing I can't lose any more of my retirement savings in the stock market.
Call now to receive your free, no-obligation analysis of what this retirement vehicle could do for you, a comparison to your current retirement plan, and a free video that explains this exciting opportunity. Start planning a retirement you can enjoy instead of worrying about future tax increases and stock market losses. Creating income that will last your entire life is the most important thing you'll ever do. Take control of your future. Call now for your free analysis, comparison, and video.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Eric Palmer. And don't forget, you can request today's material by emailing me, steve@thebiz.tv. And of course, any of the articles you want to see, we'll be happy to give them to you. And just a heads up, before moving forward with any of the ideas on the show, always consult your tax advisor and your legal counsel, as well as your broker-dealer compliance officer if you're FINRA licensed. We're featuring our insurance industry update for March 2013. Eric, the next article, I'm so sorry, this sounds like we're painting our own wagon here, but I'm sorry, I love stuff like this. DC, the article's title is DC Plan Fiduciaries are looking for ways to offer guaranteed lifetime income. They're looking for ways, look my way. Right? I mean, where have they been? Well, people are finally graduating to our thinking of lifetime income you can't outlive. And now I got the government saying that's a good thing.
What's interesting, and you know, whether or not you enjoy the person I'm about to talk about, I was listening to Howard Stern on the way into work today. And they even brought up a piece of news talking about the need for retirement planning and the need for lifetime income. And I found it kind of funny that I was listening to that theory and the discussion on lifetime income on a Howard Stern show.
Right.
So, but it goes to show you that it's on everybody's mind, and especially when we're talking about deferred compensation, that's indexed universal life opportunity, that's an opportunity for cash value life insurance, it's an opportunity for a fixed annuity, which sometimes is even ignored in that equation. We sort of levitate towards the life insurance side, but that is what people want. That's what they want to see. And if you're not in that space, or if you don't understand that space, I would get connected with some mentors or some individuals that really understand it, because for a business owner especially, that's an immense opportunity to sell some product.
It is, and I'm saying that when I have the government leading the way on articles like this, that tells me that they know they don't have the wherewithal to give lifetime income, and they want to shift the onus onto the American taxpayer or the American retiree and let them start thinking about this. And by the way, that's good for us. I think.
Well, I
that's a
say
great
go
idea.
for it. They're trumpeting our
Exactly.
cause, and when it's coming from the government, I guess it just reinforces the fact that need is something that's imperative for future retirement.
I was going to go to this, but I'm going to maybe save it for last, because that's a little nail biter. I noticed the Prudential had a fourth quarter loss. Now, this is really bothering me, because I've been in this business 30 years, and I've seen the Pru when the Rock was the Rock, and their moniker out there was just whatever. This company has the wherewithal to pull this around. I mean, turn this around. They really do. These are big players, and I think they've lost their way a little bit. But I really do believe they have the history and the wherewithal to get really edgy again. And remember, just a little side note, they own the heavyweight scene in life insurance. If your client's overweight, nobody's even second or third place. These guys own what I call the obese market.
Well, sure, and they're coming out with some new innovative product lineups. I think they're realizing that they're missing out a little bit more in the retirement space. Prudential has made some limitations on their distribution of some of their other retirement-based products, and that's really the product type or the concept that's producing the most volume in our industry today. So where indemnity sales are always going to be there, we're always going to sell term insurance or guaranteed universal life. The focus and the trend is really pointed to retirement-based, cash value, asset-based type insurance products. And Prudential is lacking a little bit in that space for certain distribution channels, and it seems to me like they're turning their head and paying attention a little bit more there.
That's so true, and I'd like to see them come back, because we're a vanguard in the day.
Oh, absolutely.
Think about this. This next article that we read here, it says advisors are failing clients on Social Security strategies for retirement. I was stunned that they haven't actually printed this article, but I have to say, Eric, I'm sorry, I agree. I cannot believe the lack of knowledge that we have on Social Security and how to make that interplay into strategy. And we did a 5-part series on this on The Biz with Ken Davis.
Well, actually, and if you go to the biz.tv right now, I think you can download a Social Security maximization white paper that we've put out in talking about how to reduce the taxation exposure and maximize your Social Security output. In a lot of cases, it has to do with triggering spousal benefits. But again, another example, I was out to dinner with some folks not too long ago. We were talking to a table next to us, a group of individuals. They asked us what we did, and we told them we focus on retirement planning, and they actually asked us about Social Security. And their question was, what do I do because I already triggered it? Well, in some instances, it's too late. We can't give you all the benefits, but it shows you that it's on the minds of everybody, because nobody's really out there talking about it. Now, you see it a lot in our publication, in our industry. Everybody's kind of jumping on the wagon of Social Security reports or white papers about it, but the actual planning aspects or the strategies that are used are not being exposed, especially to the consumers out there. So what an opportunity to market and,
It's a huge opportunity.
Maybe even redefine the way you do seminars. Start using Social Security, because people are responding to that terminology.
You cannot do retirement income planning and not know what you're doing in Social Security. It's as simple as that, and we need to go down that road, because we're leaving money on the table for the client. Here's another one, and I find this so funny. Isn't it interesting to you? Middle income earners should have an estate plan. Now, we just saw the bump up in unified credit to $5.25 million per person. But remember, everybody went up that's the Fed rate. The states did not go up with the federal government. There are so many states in the union that have high-end estate planning. If you're not talking to your clients about state estate planning, you're doing a huge disservice, because you're already thinking, well, I have 10 million plus, married couple, unified credit, why do I even bring this up?
Well, let's define estate. It's not a castle at the top of a hill with a 25-mile driveway. You know, an estate is a home, it's a family, it's all of your assets combined. And an estate plan could be as simple as a revocable living trust, just to ensure that you're avoiding things like probate on a state level. So, you know, again, I think if people think about estate planning, they think $5 million. It's not me. That's not the case. It's everybody.
That's right. So you need to up your game on estate planning for the state. And think about this as I close out the show. I looked at this article saying Index Universal Life needs to manage its clients' expectations. I'd say we need to make sure we're doing it right as advisors before we ever start telling the client what he needs to manage. Well, that's our show for today. Remember, you can follow me on Twitter, Facebook, LinkedIn, or email me at steve@thebiz.tv. Well, that's the Buzz on the Biz for today. You've been in the zone, the business insurance zone.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.